So here's a couple examples of current zombie companies that have recently gone in bankruptcy: Bed Bath and Beyond, Smile Direct Club, which did like retainers, and JetBlue. We've all heard of JetBlue. So JetBlue just recently announced bankruptcy. So a lot of this came to table in May of 2024 when BCA Research put out a paper called The Great Small Cap Heist. And I found this paper actually very, very interesting because nobody had been talking about it. But essentially what they're talking about in this paper is a shift in the way the small cap indices work. And what they call this is like the migration effect of these companies doesn't happen anymore. So let me explain that. So what happens is a small company typically IPOs, like a small tech company, any company will IPO. They'll go into the small cap index because they're under 2 billion in market capitalization. If they're a good growth story, they'll grow rapidly into large cap. That growth is where the small cap indexes really reap the return, is from that small company going into the next index. Okay. So what happened is companies aren't willing to IPO at small market valuations anymore. They wait until they're unicorns, which is a $1 billion valuation or more, and then they IPO, or they're purchased by larger tech companies like Google, who just doesn't want them to go public and wants to tech. And so what you have is this effect on these small cap indexes of these migration stories not coming to light anymore. So what's left? What you get left with in the index is a bunch of non-achieving, poor quality companies. Junk. The index is essentially junk. It's not growing anymore. You're not going to get that return effect. So if the whole point of reinvesting is to get a lower valuation to get a higher return, well, what I'm saying is maybe the valuation being much lower is actually relevant because of what's in it. Is it as good?